Welcome back. You're tuned in to Chartbusters here on CNBC-TV18. Well, let's focus on the new kid on the block. Microfinance player Utkarsh Small Finance Bank has made a strong debut on exchanges, listing with gains of more than 50%. Let's revise that. It's close to 90% now. Mr. Govind Singh, the Managing Director and CEO of the bank, joins us on the show. Hi, Mr. Singh. Good morning. And first of all, congratulations on a solid listing.
Good morning.
Maybe in fact, you've timed it perfectly as well. The markets are in that sort of a move where they're rewarding, new IPOs, and you've participated in that. So good for your shareholders. But let's address a couple of numbers because the outlook from here on is something that we're going to hold you at. Now, your AUM growth for the last few years, I think, has been roughly around 30%. What kind of a growth trajectory are you looking at from here on? And also, could you give us a sense about your cost of funds? What is it and how much has it gone up by?
Yeah, so thank you very much. So in terms of our AUM growth, it has been in the range of 28-30% during last few years. And if you look like last year, it was 31%, March 23. So, and we have invested a lot in terms of our branch network, new product services after becoming a bank. And those are yielding results, I'll put it this way. So microfinance still remains our mainstay, but we have, got many new verticals. So our sense is that the trajectory what we have seen during last 2 years or 3 years time, that will remain there. And there is no reason why it should not be there. So I'll say that, the same trajectory will continue from here in terms of overall growth of AUM or overall, you can say, balance sheet. Okay. In terms of cost of fund, our cost of fund had gone up little higher in S2 of last year, and that was across the, you can say across the board. All banks had that, and FD rates have gone up because of the, you can say the repo rates and even the rates given by Reserve Bank of India had gone up. So to mirroring that, our rate of the cost of funds had gone up a little bit during last 8 to 9 months time. But what we see now, it has almost, the growth of cost of fund is now no more there, and even the indications from the Reserve Bank are that rates will not go further up. So whatever increase happened, that is almost, I'll use the word bottomed out.
So what happens to your NIMs? Because the last time you said you will maintain it at around 9.5%. But you are also diversifying away from microfinance, which would be perhaps lower yielding. So how would you then maintain your NIMs at around this 9.5% that you've been speaking about?
So because, 2-3 things are happening. One, we have invested a lot in terms of technology, in terms of expansion, and in terms of even, creating new verticals. And those are yet to mature. So we'll get a lot of benefit of that maturity of verticals and new business lines what we have started. We have opened close to 244 branches during last 3 years, 250 odd branches and 144 in last year. So we have spent a lot of money, I'll put it this way, invested a lot, and we'll get benefit of those things in days ahead. And still microfinance will still remain our mainstay, and our cost of fund will also come down during this period. So operating costs will come down, cost of funds will come down. That will offset for the little lower yield in some of the asset classes, those we have started off late. So because of that, I think NIMs will remain protected in the same range. I'm not saying it will remain almost at the same level, but almost same range. It looks like that we'll be able to maintain the same range.
All right, so around 9.5%. You're talking about, the microfinance part of your book and the non-microfinance part of your book. So what is it now, and what would be the ideal mix?
True. So if you look at March, it was close to 63 to 64% was the microfinance book, and rest 36 odd % was non-microfinance book. So in terms of mix, we don't have any specific number, but we have seen around 6-7% decrease in microfinance share because of the, you can say, it's almost for 14 years we are doing microfinance. There is a rate of growth is lower, and the growth rate is higher for the new business verticals. Because of the, you can say, low base. So our sense is that this ratio will remain there in terms of decline of microfinance and increase of other verticals around 5-6%, at least for foreseeable future of next 2-3 years time. This trend will continue.
Got it. So over the next few years, every year there will be a decline of 4 to 5% in your overall share from the microfinance book. Final question then, with you expanding into different verticals, and you said that you're opening a lot of branches, etc. What happens to your operating profit? Do we see a near-term dent in that? And your return ratios, ROE at around 20%, ROA at 2.4%. do they maintain at these levels? So OPEX and return ratios, could you give us a comment before we leave?
So again, if you see, our cost income ratio has been among the best in the industry, and it is around in the range of 54-55%. You are rightly mentioned that there are a lot of expenses we have done during last 2 years or so, but the expenses ratio will come down because we have already spent that money, in terms of capital expenditure for branches, and a lot of IT costs has also gone up. So we will get, but still, IT costs will go up because whatever we do in IT, that gets obsolete in 3 years' time or so. So IT costs will go up, manpower cost can also go up, but we'll get a lot of economies of scale, and the overall operating cost will come down. The cost of fund, barring the you can say the market indexes, will certainly come down for us also. So overall, I think our cost income ratio should be maintainable in the same range, which is true for which is best in the industry so far.
Okay, Mr. Singh, thanks so much for stopping by. Congratulations on a good listing, but we're going to hold you to these numbers and wish you all the best. Looking forward to having a chat with you in the near future. For the time being, though, we'll slip into a short break, come back, hunting our focus on markets and stock-specific action.